This is TreppWire Week in Review for the week ending August 9th, 2024. I'm Haley Keene with Trepp, a data modeling and analytics firm for the CMBS, commercial real estate, and CLO markets. I'm with Lonnie Hendry, Chief Product Officer, and Stephen Bushbaum, Research Director. This week, there is a lot to discuss on the macroeconomic front, and we'll be sure to tie that all back to commercial real estate. Friday's jobs report showed a slight uptick in the unemployment rate to its highest level since October 2021. The Bank of Japan raised their benchmark interest rates, and the yen began to rise against the dollar after our weak jobs report. This spooked many Japanese investors, causing the Nikkei index to crash for its biggest loss since Black Monday in 1987. Also, U.S. investors who had been borrowing yen at incredibly low interest rates to buy American equities began to unwind those trades. This news plus pent-up economic sentiment got stirred up on Monday, and equity markets threw a bit of a temper tantrum before settling down Tuesday and Wednesday. Stephen, U.S. stocks had their biggest drop since 2022, Japanese stocks their worst day since 1987, and investment-grade bonds, junk-rated debt, and leveraged loans all fell on Monday. The 2 versus 10-year Treasury Yield Curve even uninverted. As the uncertainty continues, let's break it down and try to make sense of how much of an impact this will have on issuance and lending standards.
You know, Haley, I thought I had the past week's events all nicely encapsulated, in my mind, and then hearing all of it rattled back off, I kind of get dizzy and cross-eyed. Like, so much has occurred in 1 week. It's absolutely nuts, which makes it fun to have a weekly podcast. So if I had to pick off one data element that is the most concerning for the CRE market, it's definitely the jobs report. If we take the collective set of events, in retrospect, it's not too much of a shock to see what ultimately unfolded, and that was a very crowded tech trade, fueled in part by the Japanese yen carry trade, which, for listeners not familiar with the carry trade, that's when you borrow in one currency, convert it to another. Specifically in this case, you're borrowing in yen, then converting it to dollars and buying risk assets of your preference, which had been the big tech sector. So when that jobs print hit and we started to get a slide in the market, and let's not forget, the Japanese central bank engaged in historic tightening, which took the market by surprise. And so the yen strengthened dramatically at the same time the market was selling off. And so this led to a pretty dramatic downward spiral. But fortunately, most of that has corrected at this point. And according to JP Morgan, they estimate that approximately 3/4 of that carry trade has now unwound. And that's what we're seeing in the data this week, is a bit of normalization. So the ISM services print earlier this week was a bit of a relief that kind of staved off the distress. So we got stabilization in equities to at least some degree. We've still kind of ended in the red a number of days. But if we look to the bond markets, we have seen stabilization in credit spreads. And just to go back and rattle off a few numbers here for what we saw in the depths of the last week, in CMBX, one of the BBB minus indices just in 1 day blew out 77 basis points. So remember last week when I was joking about, at least we're not talking about a stick? Well, we almost hit one stick there. And that's when things do get a bit scary. And so fortunately, at least last night, I did see BBBs tightening a little bit. I'm not going to say it's anything too encouraging, but I will say if we can at least get back to some resemblance of normalcy and we get a few more data prints to bring calm to the market, and specifically today's weekly jobless claims number came in at 233,000 instead of estimate that was 240 and the prior week's 249. So we didn't have that non-seasonally adjusted number pushing up higher, which would have been amplified by the seasonal adjustments at this point in the summer that would push that even higher. So for me, the big concern is what the recent widening in credit spreads will mean for issuance, and if we have ultimately some knock-on effects in lending standards, which we'll talk about the sluice in just a little bit as well. But Lonnie, I want to get your thoughts on this past week's set of events.
Yeah, so I mean, as you kind of hit it on the head when you were saying, as Haley read the intro, it basically replayed a lot of the subject matter we've covered in a very concise format over the last couple of days. I will say at least the markets reacted this week like you would anticipate the markets to react given the news that was put out Friday with the jobs, et cetera. I think you and I have acknowledged over the last 18 months that it seems like the market does the opposite of what you would expect it to do given the prints from the Fed or the CPI prints, the Fed actions, et cetera. At least here, while you never want to be talking about Black Monday events or your biggest losses since 1987, the market's reaction, I think, actually was what you would have expected the market's reaction to be, which for me at some level is at least some comfort that maybe some sense is being put back into the market. I think the job stuff is really interesting because we've been highlighting this as the unemployment rate being the trigger that maybe forces the Fed to pivot. So I just want to add a little bit of context here. So the job growth totals were 114,000 in July, which is a lot less than what was expected, down significantly from the 179,000, which was the final revised number in June. And unemployment, as a percentage ticked up to about 4.1%. Just to give some context, though, I wanted to provide a little bit of insight. If you look at other historical, kind of peak to trough type of unemployment data, November of 1982, unemployment was at 10.8%. Right. You go through like the savings and loans crisis, you get into the early 90s, you basically have unemployment at 8%. You go fast forward to 2009, unemployment peaked out around 10%. So right now at 4.1%, it's a lot higher than it has been, and it's a cause for concern. But on a relative basis, I don't think we're anywhere near where we've been during other significant macroeconomic downturns. Now, if that number continues to increase, maybe it becomes more problematic. I think really the 4.1%, if it goes to 4.3, 4.5, 4.8, that does become more of an issue for the CRE markets in particular, because I think it to your point, Stephen, the lending environment maybe tightens up even more, and consumer confidence and the stuff that drives those transactional markets maybe tighten up. But I think broadly, if we're at 4.3, and I misspoke earlier, I said it was 4.1, it ticked up to 4.3 from 4.1. I don't think, putting it in context, 4.3% unemployment rate on its own is not enough to tank the market broadly. But some of these other things that you highlighted with the trades, the global connectedness where people are leveraging other currency to make trades, it does create some additional volatility, which when combined could be really, really negative for the markets.
Yeah, one data point that's interesting, speaking of the unemployment rate, is the SHAM rule, SAHM. And I don't know why I have a tough time pronouncing that, because I think of like the sham wow towel, So anyway, this rule states that when the 3-month moving average of the unemployment rate rises by 0.5 percentage point or more from its lowest level over the past 12 months, the U.S. economy is in the beginning of a recession. And we were right on the edge of that rule being triggered prior to last Friday's jobs print. So when that unemployment rate ticked up to 4.3%, that rule came into play. Now, what's really interesting here is that Claudia Sham, who is the chief economist at New Century Advisors, said, quote, "Our understanding of what is happening right now is so very challenged. And what that means is, and I'll be the first to say it as someone who has a rule attached to her name, don't just rely on one tool." So this is really interesting that a widely watched recession indicator has now flashed recession. We're not in a recession. The momentum is building that way. But the rules inventor is saying that interpreting everything that's coming at us right now is very, very difficult. And I think that's very fair given the geopolitical landscape and really what's potentially going to happen in September if and when the Fed does cut by 50 basis points, because that now looks like that's in the cards. The probability of a 50 basis point cut is up from 22% a week ago to now just about 70%.
When I see that indicator, Stephen, in print, I think of the acronym Stay at Home Mom. So it's kind of funny. I did want to highlight one other thing as we transition out of here. On the GDP growth, we saw that GDP came in hotter than expected on the last print. I actually saw an article this week, and I don't think we have enough detail to dive into it, but they were suggesting that GDP going forward might be the measure of the gross data product. The data is the currency that should be used to measure economic viability and kind of how strong the market is, transfer of data and information and insights. So that, obviously not going to happen broadly in this quick of a time frame, but it does highlight maybe that some of the metrics we're using to identify strength or weakness in the economy is somewhat dated relative to where we're at in the current new tech-enabled economic market that we actually live in.
No, I think that's absolutely fair. And if we look at what drove the sell-off this last week, it was a crowded trade in big tech driven by exactly that sentiment that data drives everything these days. When that trade unwinds, well, the cross correlations drag everything down with it. Think about how much of the daily trading volume is driven by algorithmic trading right now, and it's 95% or something absolutely ridiculous. Plus, let's not forget there's been a massive shift into index or passive management. You don't have much active alpha, though that is coming back into vogue these days.
So another headline we saw this week coming from the Wall Street Journal was about retail real estate, and specifically talking about department stores and how they're bleeding customers and landlords no longer view them as magnets for shoppers. We had a few cool guest podcasts over the last few months with Carmen Spinoso of Spinoso Real Estate Group and Oscar Para of Pacific Retail Capital Partners. They gave us their perspective on what they're seeing with malls, but let's talk a little bit about this article. And I know we have some Trepp data to showcase what's really happening with distress rates in super regional and regional malls.
Yeah, so Haley, this was a really interesting story, and I think it's a topic that's been discussed widely for a very long time, but just maybe for our listeners that aren't as familiar, talk about retail real estate. It's really broken out into specific property sectors. And even within those sectors, you have some additional delineation. So you could say mall property sector, but within the mall sector, you have super regional and regional malls as two more delineated or subtypes. So just for some definitional purposes, super regional malls effectively are similar in concept to regional malls, but they offer more variety and assortment. There's about 620 per some data that we pulled super regional mall info. Aggregate gross leasable area on those is almost 1 billion square feet. And if you look at the average size of the super regional mall, it's about 1.3 million square feet. If you look at the lot size or required acreage to build a super regional mall is somewhere between 60 and 120 acres. And they typically have 3 or more branded big box type of national chain anchors at the center. And those anchors represent somewhere between 50 and 70% of the total gross leasable area. And their typical anchor types would have full or junior department stores, mass merchant or discount department store, and or fashion and apparel store. And their typical trade areas of 5 to 25 mile radius. If you look at a regional mall, it's very similar. General merchandise or fashion-oriented offerings typically have inward-facing stores connected by a common walkway. About 600 of those in terms of volume. Aggregate gross leasing area is about 400 million square feet, and typical size for those are 400,000 to 800,000 square feet. So, on the upper end, they can be similar to super regional malls in size, but the typical size is about 200, 300,000 square feet less. They usually require 40 plus acres to develop, 40 to 100. They usually have 2 or more anchor tenants, and their anchors represent 50 to 70% of the gross leasable area. You're going to see full-line junior department stores and effectively the same type of shoes and apparel and other things that you would expect in a retail center. Their trade area is slightly smaller with a 5 to 15 mile radius. So now that we've kind of highlighted some of the definitions of regional, super regional mall, in terms of just distress, surprisingly, the super regional malls are actually doing better than the regional malls are. So I think maybe that enhanced trade area, the higher branded tenants might be driving some of that experiential retail comeback that they're talking about. So if you look at delinquency, the super regional malls are sitting at just over 4% delinquent, whereas regional malls are about 14.4%. If you look at specially serviced assets, about 12% on the super regional mall side are being specially serviced compared to 22% on the regional mall, and about 14% are on the watch list for the super regionals and 19% for the regional. So Stephen, I don't know from your perspective, is this the byproduct of the regional malls just being mostly class B and C at this point and not having the upgraded improvements to attract the top credit tenants? Or is there something behind the scenes that's maybe driving this disconnect between regional and super regional mall performance?
I think that's definitely part of it. And you think of the super regional mall phenomenon, when those were built and specifically where they were built. We're going to get into some location theory here, right? Those super regional malls are very tactically located close to major thoroughfares to try and capture as broad of an audience as possible. So what'll be interesting to watch is while super regional malls have outperformed, I'm curious to get your thoughts on this, Lonnie. Part of what's really been driving the strength, the resiliency in the super regional mall sector has been the higher end retailers. How resilient will those be if we do take a bit of a rough landing here, which it seems entirely possible. The chance of recession has now moved up, according to JP Morgan, from 25 to 35% for next year, which is a drop in the bucket. But let's keep in mind, if the Fed is dramatically cutting rates here, the carry that you're going to get on savings is going to be a lot less. And in the meantime, let's just go ahead and factor in that your stock market wealth is probably going to decline as well as everything reprices. And so will we get the same spending and resiliency, or will we see the super regional malls start to falter? Way too early to call this, but just curious what your thoughts are on how resilient that high-end consumer will really look like if the economy hits the skids.
Yeah, I mean, we've highlighted that during this disruption, the higher end of the economic spectrum really hasn't been impacted as negatively because interest rates going up has actually boosted their earnings potential and savings and their stock portfolio, et cetera. To your point, if that shift goes the other direction, I think it definitely causes some concern for these high-end tenants. When you're looking at Louis Vuitton, Gucci, some of these other name brand high-end goods and service providers, people are not going to be spending their money on those items if the market starts to falter. And I think the experiential component of the super regional mall, where they open up really elaborate food halls and other things, like by definition, those luxury type of endeavors suffer when consumer confidence comes down and people start to tighten their belts a little bit. So to your point, I think there's a long tail there, and it's not going to be like an overnight where people just stop going. But I do think over the next couple of quarters, you could see, if the market continues down this path, you could see some pullback in some of those luxury goods. We've seen it at the grocery store when we've highlighted that people have stopped shopping at Target and some of the other more upscale, family-oriented type of shopping, and they've moved to Walmart or the Dollar General or Dollar Tree, et cetera. You might see the same type of retrenchment in the super regional mall space back to a discount retailer like Kohl's or something like that. So it's like what do we call that? A mixed green? Like this is probably a mixed green outcome where it's net negative for the super regional malls, but it's probably a positive for some of these discount retailers that are struggling a little bit more right now.
And another headline we saw this week in the Wall Street Journal was about Fannie and Freddie poised to be tightening their real estate lending rules. We've been talking about this for a long time. We know that there is going to be increased scrutiny for banks, especially ones that have high concentration of CRE on their books. So this is something that Trepp can help you with if you're a listener and you're worried about that or thinking you need to get ahead of that. Reach out to us. We have a lot of solutions for stress testing, underwriting, monitoring and reporting on your loans, and capital adequacy. So send us a note. We can give you some perspective on what's happening, what type of exposure you have, and also some of the solutions that we may have that can support you.
This is actually a bigger indicator of where we're at in the market cycle than some of the macroeconomic stuff. To me, this tightening of lending rules and kind of reining in of capital flows is indicative of us bottoming out at some level around market valuation, kind of the wild west of capital being available for people that want it without regard to track record and other things. You see this every time there's a really high profile run up in valuation and activity. And then as things start to trade at a discount or the market slows down and foreclosures start happening, you see this tightening up. And I think for us to see this now is pretty indicative of kind of where we're at in the cycle. Like, to me, this is net negative from a headline perspective of saying Fannie and Freddie are going to be tightening their lending rules. But I think from a market perspective, that's what you need. We want qualified borrowers, assets that actually produce the necessary cash flow, sponsors that have experience in doing what they're supposed to be doing on the ground, getting access to these funds. When things get loose and everyone can take out loans, it becomes problematic in the sense that they just don't have the execution acumen to actually deliver the results, which means people lose money. So obviously we want capital flowing in the markets, our business, and those that are in the production environment. The more deals, the better. But the reality is, at some level, you need this market correction in terms of lending standards, guidelines, rules, implementation, et cetera, to keep the market from becoming something that the data can't support.
I think this is a good opportunity to weave in the SLOOS, or the Senior Loan Officer Survey, which showed kind of a similar trend to what you were just referring to, Lonnie, and that over the second quarter, significant net shares of banks reported having tightened standards for all types of CRE loans. So significant net shares of banks reported such tightening for all CRE loan categories, and this is an interesting piece, while large banks reported that lending standards were basically unchanged for all types of CRE loans. So there's the plateauing of the tightening cycle and lending standards that you're referring to. Meanwhile, moderate net shares of banks reported weaker demand for all types of CRE loans, which I think we kind of all implicitly know looking at issuance numbers. Granted, CMBS and specifically SASB issuance has been absolutely stellar this year, so it'll be interesting to watch that over the second half. Now, similar to domestic banks, a moderate net share of foreign banks reported having tightened standards for CRE loans. However, in contrast to domestic banks, a moderate net share of foreign banks reported stronger demand for CRE loans over the second quarter. So an interesting dynamic here that is tempting to say, well, we've bottomed out and we're on an upward trajectory. However, we have to keep in mind how to interpret this data, right? It's the net share of banks tightening or loosening or keeping standards unchanged. So just because banks have kept things unchanged doesn't implicitly mean that things are getting better. And specifically to that point, if we look at where we've come from, the net share of banks reporting tightening lending standards, granted, is lower than what was reported in the July 2023 survey. However, we're still at the tighter ends of their historical ranges for all categories. So to say this, another way, and in very simplistic terms, things are slightly better, but lending standards are still incredibly tight across the board. And as we've been saying all throughout this podcast and for weeks now, if the economy does hit the skids and things turn out worse than what's being priced in for a soft landing, this trend could easily reverse. But basically, banks are trying to position themselves as carefully as they can. And we've seen some slight loosening around the fringes for those areas where banks have high value in the relationships that they depend on. But on balance, if we look at the LTVs and CMBS, things have ratcheted in pretty dramatically. I would say we're at least 10 to 12% tighter on LTVs than where we were 2 years ago.
Yeah. So my question, Stephen, is let's assume the Fed comes out with a 50 basis point rate cut. That's going to create this psychological environment where people are like, we're risk on, deal on, let's go. Does that change the narrative that we just talked about, where lenders are then forced to say, we got to seize the opportunity, we got to make loans? And so you see a little reversal of some of these tightening. Or do people start looking at their calculators and saying, like, even during this cycle, we're still seeing multifamily cap rates on trades in the 4% range when borrowing costs are 7%? Like, we're talking about tightening standards. The data suggests the LTVs are significantly less, et cetera, but you still have a lot of deals that are being publicly announced that are going in with negative leverage and assuming some sort of increased NOI, value add, some sort of play over the longer term that still seems very aggressive, if you ask me.
I think we're going to see, well, we've maybe overused this term at this point, but bifurcation. There will be some segments that see really more green shoots than crabgrass here. So multifamily could be one of those, because the dramatic drop in building permits and starts basically is signaling in certain areas that we're going to continue to have constrained housing supply, which is going to push up rents and justify the negative leverage going in on those deals, because the future rent growth is going to ultimately bail you out of that deal. Now, that being said, I think lenders are wise enough to say, well, we've seen this play out before, and we're not going to just clamor over one another when we're still dealing with a good share of stress on our balance sheet. So they have limited incentive to stretch beyond, well, just trying to win business and stay relevant to the market. And that's the really difficult part of where we're at in the cycle is loan demand will likely pick up and lending standards are likely to loosen somewhat, but really in selective sectors. And lenders tend to pick their targets very, very tactically in this sort of environment, which means there will be some winners. There's also going to be some inevitable losers.
All right, so let's turn to some of the stories that we covered this week across property types. We can start with office, and we saw an article according to BizNow that Fannie Mae opted not to vacate its more than 700,000 square feet that it occupies in its headquarters at the Midtown Center office complex in DC.
So this is definitely a mixed green, because Fannie Mae vacating this location would be incredibly detrimental to this property that we've talked about a couple times in the podcast. Now, unfortunately, Fannie Mae will be shrinking its footprint pretty dramatically. So they'll be downsizing from the 713,000 square feet they currently occupy down to 340,000 square feet. So Midtown Center that Fannie Mae occupies is a 14-story trophy office building totaling 867,000 square feet and has a 3-level underground parking garage at the northwest corner of 15th Street Northwest and L Street Northwest in downtown Washington, D.C. The Midtown Center was constructed in 2017. The housing agency has been a tenant at the two-building complex since it was developed in 2017. It's subject to a lease that runs through September 2033, but it has an option allowing it to terminate its agreement as of May 2029, as long as it pays a $66 million fee. So far, it has paid $52.33 million. Midtown Center, owned by a venture of Car Properties of Washington and IGIS Asset Management of South Korea, is encumbered by $525 million of debt that's securitized across 3 CMBS transactions. The thinking earlier this year was that Fannie Mae would vacate the property in its entirety, but instead the agency has come to a new lease agreement that runs from June 2029 through 2045. Fannie will pay an additional $18.4 million to reduce its footprint ahead of time. In February, we wrote that WeWork, which filed for bankruptcy last November, would not be quitting all of the 109,000 square feet that it takes at Midtown Center. So, thankfully, Haley, we were able to weave in WeWork once again during this podcast. So WeWork's lease doesn't roll until 2036, but it has worked out a deal with Car Properties that effectively reduces its footprint and rent. So it's a mixed green for this center, but I would say for me, this tends to be much more positive than negative, given what we were thinking was going to happen earlier this year.
Yeah, so of course we have a WeWork story this week, and I don't think we told our listeners this, but last week we might not have had a WeWork story, but Lonnie was recording live in a WeWork last week because he is a dedicated podcast host and didn't have good Wi-Fi in his hotel, so he rented a WeWork and made it work, but we were all just internally laughing that even when we don't have a story about WeWork, we're still connected to them in some capacity.
Yeah, we're going to have to start charging WeWork for some of this advertising time we're giving them on the podcast here. I mean, it's every week we're talking about these guys. And, as we talked about internally last week, I realized some of the challenges with their WeWork. I called them, no one answered. They were not open yet. They said you have to, on the recorded message, talk to someone in person. I go to the building in person. They say, sorry, we can't help you. You have to download the app. So I had to download the app and then I could rent a space. Now I'm a member though. I'm in. So like on these travel trips that I'm at, if the Wi-Fi is no good, I'm going to WeWork. I on this story though, Stephen, in particular, I would agree with you. This is a mixed green with probably more positive than negative, but it kind of feels like this is when, you're young and you're dating and your girlfriend says, yeah, I just don't think that we should be together anymore, but we can still be friends. That's kind of what this feels like. Like, we're going to vacate. Okay, no, we won't vacate. We're going to just downsize. But they're going from 700,000 to 300,000. They're going to pay a sizable fee to stay in the building. That's great, but it's a net negative for the building owner in the sense that they had a really long-term lease agreement with a government tenant that they thought was going to be really great for them. And now in this office environment in DC, you're talking about trying to backfill 400,000 plus square feet in a market that's very, very difficult to do that. So I would agree with you. It's a mixed green, but I got to feel like the owners here, they're happy that they're not leaving, but they're probably still not super comfortable that they're staying either.
Yeah. And in fairness, for me, this is a bit of a personal story because I've been looking at this, imagining how ugly it could get for this property, given how weak the leasing market is in Washington, D.C. And I can't help but wonder what kind of a signal this sends across the broader D.C. market, because I can't remember who put out this stat, which agency it was, but apparently the utilization rate for government occupied space is something like 25%. So the fact that they're reducing their footprint by roughly 50%, it tells you just how much excess space there probably is that could be let go in the DC market.
It was interesting when I was in DC, as we mentioned, I met with Senator Gary Peters. This was a topic of discussion for us, and he was acknowledging the fact that federal government workers need to get back in the office to bolster the DC office market. And there's going to have to be some sort of activity, legislation, remarks, something that drives that change, that the DC market is so dependent on government workers being in the office that, to your point, having utilization rates that are in the very low double digits just doesn't cut it for the city. And it's driving real negative challenges for the other retailers and other, multifamily and other owner operators in that market. So there were no specifics obviously discussed, but when I got to this topic and we started talking about some of the challenges in the DC office market, tied that back to the lack of workers physically being in the office, he was very keen to say that it's a very heavy topic of discussion for them on the Hill.
Yeah, I mean, because the knock-on effects, you see this bleed over into retail, you see it bleed over into multifamily, and then if we think about the aggregate value destruction and what that means for ultimately property tax receipts and services the city is able to offer, the longer term impacts of inaction are incredibly detrimental to the city. So something has to give here.
So we have one other story here in the office sector that we'll talk about quickly, Stephen. This is a property at 220 Northwest 8th Avenue. Collateral behind a $19 million loan had a significant appraisal value reduction according to the July data. This loan was transferred to special servicer in February due to loan payment default. The loan became current on payments in April and May, but the loan is now 30 days delinquent as of July. This is an office building in Portland, Oregon. It spans about 70,000 square feet. It's 67,000 square feet to be exact. Property built in 1901, renovated fairly recently in 2017. When the property was securitized back in 2017, it had an appraisal value of $30.4 million. However, most recently, the appraised value was reduced to $7.5 million, which is less than half than the current outstanding loan balance. If you look at the financial performance on this asset, debt service coverage ratio at net cash flow fell to a negative 0.77 times in 2022 from 1.76x in 2021. If you look at the 9 months ending September 23, the loan posted debt service coverage of negative 0.61 times. Back in February of 21, we wrote that WeWork was closing its U.S. Custom House location, which is the property behind this loan. They were the sole tenant, taking up 100% of the space on the lease that ran through 2032. Obviously, we won't get into the details of the bankruptcy and so forth with WeWork, but effectively it had really negative implications for this property that's now playing out. And this is another story for us. It's another week, another office story where the appraised value is now some percentage less than the current outstanding loan balance.
Yeah, it seems like every time we see an appraisal reduction story in the office sector, the value change between securitization and current day is somewhere to the tune of 50 to 70% in so many cases. And the year-over-year declines are coming in about 10%, give or take.
And so it's interesting. I was asked to provide some thoughts on an article that was written this last week around what's keeping us up at night. And that was really the central theme of my commentary, was that the value reduction in the office sector hasn't actually been played out or realized in the marketplace. So I think I'm very bullish, honestly, across the other sectors like multifamily, industrial, et cetera. Increased interest rates haven't negatively impacted those markets to the level that you would maybe think based on the headlines. You're still seeing refinances, purchase agreements, et cetera, et cetera. The volume is less, but you're still seeing a significant amount of deals. New issuance for those sectors has been really good in 24. But for the office sector, all of these distressed offices that are, falling behind on payments and having to get a new appraisal done, the average value loss in those appraisals from 23 and 24 has been somewhere between 40 and 50%. I'm not suggesting the entire office sector needs to be marked down 40 or 50%, but I am suggesting there's a lot more distressed office that needs to have a 40 or 50% realized reduction than what the market, the lenders, et cetera, are actually doing at this point. It's still very case by case. And I think at this point, you could take a broader brush to say, you're functionally obsolete Class B office building, you've had some real value decline probably to the tune of 20 to 40%. And if you're distressed, that number is probably 40 to 60%.
Yeah, and what it really takes is a trigger event. So there's been some frustration about whether or not the change in banking regulation is hiding distress on balance sheets. And I would say to some extent that's fair, because banks are not going to mark down an asset that's still cash flow positive performing and where there's at least an expectation that the borrower will support it in the near term. But the fact of the matter is the value has certainly dropped and the LTV is dramatically higher, but that debt service coverage trigger just hasn't been realized. So with loans coming to the maturity, typically lenders want to see at least 2 years of they want to have leases expire at least 2 years beyond when the loan is set to mature. And so if we think about these upcoming maturities and the leases that are likely to roll around that near term, again, not to berate this topic, but if the economy hits the skids, things could look a lot worse across a broader swath of the CRE lending market, specifically for the office sector. I would say self-storage is one other one that we haven't talked a lot about, but just on the topic of revaluation, I wanted to toss out one little fun fact. Blackstone updates or provides guidance on how they're valuing various property sectors, and self-storage actually had one of the largest blowouts in spreads. So their exit cap rate increased about 100 basis points on a year-over-year basis for that sector.
Yeah, and I've seen here in Texas, we've had a significant number of these rural type of self-storage developments where you had people getting into the space that maybe weren't experienced in the space, 70 or 80% complete, and then the project stops because they run out of money. And so they've maybe leased up some of the property that was built, at the early stages, but the back half of the property or the 30% that's unfinished is just bare metal, no doors, etc. And it's going to be interesting to see what happens there. I think you're right. Self-storage has some real headwinds that it's facing. So I know we have a couple of other credit stories. So let's transition here to our retail story, Stephen. We had one. It's $18 million Fremont Merino 3rd Street Promenade. Say that 3 times fast. This loan was transferred to special servicer at the beginning of June for balloon payment default at maturity. As of July, the loan had the delinquent status of non-performing matured balloon. This is a 14,400 square foot retail convenience center located on the 3rd Street Promenade in Santa Monica, California. Was built in 1948, was last appraised at securitization in 2014, and had an appraised value at that time at $32.3 million. So the property was sitting at 0% occupancy at the end of 23. It had a tenant, Foot Locker, which had leased 7,500 square foot of space, but they had vacated the property. The silver lining, if there is one for that tenant in the story, is that Foot Locker was continuing to pay the rent, even though they were not occupying the space. The borrower requested an extension in March, but it was denied. Financial performance here, first quarter 24, loan posted DSCR at net cash flow 1.2 times. In 2023, the DSCR had been 0.99x. So this is another one. We've had some really good, strong performance across the retail sector for these types of properties. This is a great location in Santa Monica. I would assume that they're going to get this turned around and this property makes a comeback. Here we are with a matured balloon date having passed and a property that doesn't have currently any tenants occupying it.
And then we had a mixed use segment a few months back where we kind of gave an overview of what that property type is. So if you're interested in that, reach out to us and we can send you that episode. But we had another story there looking at a mixed use property that is in foreclosure.
The Urban Edge Properties lost the Kingswood Center mixed use property in Brooklyn, New York to foreclosure. Urban Edge purchased the property at 1630 East 15th Street in the borough's Midwood section in 2020 for $88 million. The debt on this property is $65.5 million. The Kingswood Center has 83,000 square feet of office space atop just under 47,000 square feet of retail space and had been fully leased at the time of Urban Edge's purchase. A total of 58,000 square feet of its office component was taken by Visiting Nurse Service of New York under an agreement that had rolled in June 2022. It ultimately signed a short-term renewal, but for substantially less space. Well before that, in late 2020, New York Sports Club, which had occupied just more than 20,000 square feet, vacated its space. The loan had transferred to the special servicer last year as it was expected to default. Last August, the property was placed in the hands of the special servicer. Earlier this year, its collateral, which was constructed in 2007, was appraised at $49.1 million, so well below the loan balance of $65.5 million. The DSCR, based on net cash flow, had been under 1.0 times since 2020, and in 2022, the DSCR was 0.72 times when occupancy was 78%. As of June 2023, the DSCR in the loan has now dropped to 0.49 times, and the property's occupancy is expected to plunge to 35% when Visiting Nurse vacates. Urban Edge, which last year took a $34.1 million charge against the property's value, said it lost it through foreclosure on June 27th, extinguishing what by then had become $68.6 million of indebtedness. After default, interest was taken into account. The company said it generated a $21.7 million gain on the debt's extinguishments. So this was actually a positive, given that Urban Edge had already taken a write-down on this asset and was able to basically de-lever.
These are those types of stories, Stephen, where you see top of the market pricing, fully occupied property, limited upside, and you see the downside playing out real time where when you're 100% occupancy on the retail side and you have some stuff that happens, unfortunately, the foreclosure process or getting underwater can happen very quickly. And I think, just tying this back to the macro intro that we had this morning, like these types of stories are going to become more prevalent as we enter this downturn in the market where people bought properties based on cash flows in place with really strong tenants and 100% occupancy, when maybe stabilized market occupancy for those assets over a 10-year time frame might be 85 or 90%, but the deal was underwritten at something closer to 95 or 100%. And as soon as somebody moves out, the economics just don't work for the operator.
Speaking of top of the market values and some of the struggles that the market is facing right now, I ran some interesting data earlier this week for a press request for one of our friends at PEI. And the topic that we were chatting about was how 5-year loans were performing relative to 10-year loans. Because if we think back to what happened in the 2008 GFC, the 5-year loans that were taken out in 2007 matured at basically peak distress in 2012. And so I'm questioning if we're seeing some of that playing out right now. Because if we look at the delinquency rate for 10-year loans versus 5-year loans today, 10-year loans, well, let me actually back up a little bit. As of July 2024, the overall CMBS delinquency rate was 5.43%. If we look at the 10-year loans, their delinquency rate is actually lower than the headline delinquency rate. It's 4.77%. Now, drumroll, Lonnie, what would you guess the delinquency rate is for the 5-year loans currently?
I have about a 50% chance here, right? Because if I say lower, I could be right, or if I say higher, I could be right. So I'm going to say higher.
How much higher? Is it a multiple?
I would say 50% higher.
5-year loan delinquency rate in July of 2024 was 11.68%.
Wow.
I mean, just absolutely brutal. And that's up from, let's see, a year ago. Actually, that's not fair. About a year ago, we were hovering right around the 8-9%. And dialing that back to 2022, we were in the 4 or 5% range. So even back in 2022, the 5-year loans were still underperforming the 10-year vintage, but that has gapped out dramatically. So those loans that are coming due in a very unfavorable market are facing really weak refinancing prospects. And I would say a good chunk of that percentage is made up of non-performing matured balloon loans. And there's a pretty good chance that we're going to see more of that roll through, because one of the games that was played in trying to reduce your borrowing cost was to shorten up your duration. And that's a very risky game going into a market correction.
These dynamics, though, are what create opportunity for everyone, right? So I know we cover these from a data-driven perspective on the podcast, and sometimes it can be construed that this is super negative or this is super whatever. The reality is this is creating opportunity for other market players that have capital on the sidelines or dry powder to come in and potentially buy assets at a discount. And so the 5-year paper trades for some of these that don't pan out, net negative for those owner operators, but could create some opportunity for other people to come in and revitalize those assets, or maybe make them a little bit stronger for viability in the market coming out of this downturn. So I don't want us to get too hung up on the fact that delinquency rates may be higher or this or that. Like, those are factually correct. But the reality is, one person's loss creates another person's opportunity. And I think we're starting to see some of those trades play out. And honestly, to the discussion we had last week or week before last, we were talking about market bottom. You have to have that in order for you to actually bottom out and then start on the uptick.
Yeah. And in fairness here, if we look at what percentage of the overall CMBS market each of these cohorts represent, the 5-year paper only represents about 9 or 10% of the overall market. So we shouldn't blow this out of proportion here. The 10-year paper is much, much more prevalent. And the combination of those two gets you to about just about 2/3 of overall market share on a dollar-weighted basis. So yeah, the 10-year money is much more important from an overall perspective. And if you just do some basic, back of the envelope math and kind of ignore the 7s and all the other maturity profiles, if we just take a 90% and 10% weighting for the 10-year and 5-year loan delinquency rates, miraculously, it gets you to about what the overall headline CMBS delinquency rate is currently.
And lastly, we have a story in lodging about a loan backed by a hotel in Fort Lauderdale that has transferred to the special servicer.
Yes, the $22.4 million Marriott Fort Lauderdale loan was transferred to the special servicer at the end of June for imminent maturity default. The loan is scheduled to mature in December, so this was an early transfer event. The loan collateral is a 315-key full-service hotel in Fort Lauderdale, Florida. It was built in 1986 and renovated in 2008. The property was appraised at securitization in 2014 at $41.2 million. In 2023, the loan posted a DSCR based on net cash flow of 1.38 times with occupancy at 78%.
If you look at that MSA, Stephen, Miami, Fort Lauderdale, West Palm Beach, Florida, in the lodging sector, they're actually at 0.3% when it comes to delinquency, super low delinquency. So I think this story caught some people's attention because that hotel market has been really, really strong post-COVID. So this is an interesting story to see a hotel like this in a market that's been relatively strong having some challenges. If you look at the top 50 MSAs, and again, this data is coming from our Trepp CRE platform. If you look at the top 50 MSAs across the U.S. in the lodging sector, delinquency is about 6.76%. Fort Lauderdale, Miami, as I mentioned, is at 0.30%. So really strong market on a relative basis.
Yeah, when I look at the occupancy on this deal and the debt service coverage, I just have to think expenses are absolutely brutal right now, and that's got to be part of the equation.
And that's not going to be getting any better with the hurricane that just passed through that's now making its way up the East Coast and dumping rain at historical levels. And they're predicting all the way up to the northern tip of the eastern coast over the rest of this week. Those insurance expenses and just other expenses are going to be astronomical for a lot of those markets going forward.
And then for programming notes this week, our research team has put together a lot of good in-depth content that we wanted to make our listeners aware of, starting with our CMBS loan loss report. So this is a report that we publish every month where we look at the volume of loan losses, and we actually found that that volume decreased in July 2024. We saw that there was $232 million across 11 loans that resolved with $119 million in losses total. So there's a lot of other great data in here, and we also have a part 2 where we actually look at the largest loans that resolved for a loss. So we have some hotel, retail, and mixed use loans that we tracked in there. So if you're interested in that piece, send us an email to podcast@trepp.com. And then another one that we wanted to tease out a little bit preliminary is a report that our own Vivek on our team has been working on, which is an office valuation report where we actually looked at office loan vintage and year built to really get a breakdown of performance. So we'll have this piece in the next few days, so stay on the lookout for that. If you're not on our email list, you can subscribe to make sure you get all of our research sent to your inbox.
So just a quick highlight on some of the valuation trends that we teased out in this report. We looked at valuation changes by age cohort, breaking it down for pre-1950 vintage buildings, and this is on the original build date, ignoring whether or not a property has been renovated. We do have in this report a breakout for the renovated and non-renovated properties by year built. But if we just lump all of these properties together by original build date, the pre-1950 vintage had the most significant average total value loss, clocking in at minus 60%. And that's the change from origination to current day. And that works out to an average value loss per year. And this is a compound annual rate. So the average value loss per year of about 11%. On the positive end of the spectrum, at least on an average value loss per year, the properties built between 2000 to present day had an average value loss of minus 48.5%, which came in at an average value loss per year of minus 6.9%. And the best performing in terms of, this is the best of the worst here, but the least negative average total value loss was for the 1950 to 1980 cohort, which saw a total value decline of minus 37.5%. So when Lonnie mentioned earlier in the podcast, the range of 40 to 60%, this is generally what we're basing those observations on.
All right, so turning to shout outs, I think you mentioned this earlier, Lonnie, but the article you referenced was actually an article in Urban Land Institute by our friend Beth Matson-Teague, who I believe is a listener, so hopefully you hear this shout out. But that was a great piece, and I wanted to just call out that a lot of our friends in the industry were also quoted in that piece. So Brian Bailey, Lee Overby, Jamie Woodwell, and Jessica Lee. So a lot of key people in the industry got to share their sentiments alongside Lonnie. If you're interested in that piece, we shared that on our LinkedIn, and it's just great to hear from all the experts across different fields and segments in commercial real estate. And then a bunch of inbounds that we got last week. Manish A was interested in the bank and CMBS loan loss data that we talked about a few weeks ago. We have some slides for that, so if anyone is listening and didn't get to see the graphs and charts associated, please send us an email. Ravathi G was also interested in some of our data from last week. George M just listened to the last episode and said it was actually the first time that he's come across the podcast. So it's great to see that we're still having new listeners join us every week. He was really interested in some of our AAA CMBS data and bank CRE exposure. Jeff L thanked us for meeting back at CREFC in New York in June. and was interested in learning more about some of our historical data. Zach A was interested in our criticized bank loan report and wanted us to look into CMBS spreads today versus historical. That's something we can definitely add to an upcoming episode. We've done a few of those segments, but we'll make sure to bring that back and give everyone an update. Arthur F was interested in our Market Pulse recording. Gary W was also interested in the same. Paul C thanked us as always for pushing out relevant content to the industry and wanted to see some of our bank data for his team to visualize. So I think we sent that over to you. Randy S has been listening every week for about 6 months and said we provide a new lens to his commercial real estate education. So thank you, Randy. I think he also gave us an invite for a podcast guest. So we will look into that and get back to you and see when we have some time in our schedules. But thank you for reaching out. And on LinkedIn, a bunch of people shared our episode. So thank you for that. Todd S gave us a shout out for the discussion about how to define a bottom in commercial real estate markets. And he said his friend Matt W was actually the one to put him onto our podcast. So thanks, Matt, for sharing and recommending us. Matt L really enjoyed the podcast. And Tyler L said it's always good to take a listen or read what others are saying about your commercial real estate industry. And another shout out to our friends who run the CREI Summit. We got to meet with Ken A and a bunch of his team members who run their committees this week. We will have some cool stuff coming out with them through our subsidiary Commercial Real Estate Direct. So we're taking part in their conference like we spoke about last week, but we'll have some more about what they do and who are some of the leaders in their organization. So we're excited to partner with them on this initiative. And we brought up our live podcast that we're recording at the Western States MBA conference last week. But if you're going to be there and you want to book a meeting with us, we'll have our team and some members of the Trepp team there. We'd love to chat with you, just talk about what you're seeing in the markets, give you an overview of any of our solutions if you're interested, or just hear why you're a listener. So send us an email to podcast@trepp.com if you'll be at that conference in Vegas in early September. We'd love to book some time to connect with you. And I'll give a last shout out to my team members, Carly and Mariana, who are listening in today and will be helping out with some editing and production over the next few weeks as we shift around and take some vacations on the team. So thanks for joining us today. And with that, we'll close. Join us next week as we look at what's happened during the week and how it may be impacting you. If you have a question or just a comment, send an email to podcast@trepp.com and subscribe to the TreppWire podcast with your favorite provider. Thank you for listening and stay well.
All right.